So have you ever stopped to think about what really keeps a giant company, on the rails? It's not just about having some amazing product or a famous CEO. Nope, there's this powerful, kind of invisible framework called corporate governance. You can think of it as the official rulebook for the company, the thing that makes sure the game is played fairly for everyone, from the top executives all the way down to the person who owns just a single share.
All right, so why is this such a big deal? Well, this quote right here pretty much nails it. When that rulebook gets tossed out the window and governance fails, the results can be, well, spectacular in the worst way possible. I mean, we've all seen the headlines, right? The massive corporate scandals that just vaporize fortunes and destroy jobs. This isn't some dry academic topic. This stuff has serious, real-world consequences that can impact every single one of us.
Okay, so to really get why these rules are so incredibly important, we got to go back to the root of it all. We need to look at the one fundamental problem that corporate governance was invented to fix in the first place.
And here it is. This is the absolute heart of the issue. In pretty much every big company you can think of, the people who own it, the shareholders, are not the same people who are actually in charge of running it every day. That's the managers. And this split, this separation between ownership and control, it creates a natural conflict. And that is the main challenge that corporate governance is all about solving.
All right, let's dig a little deeper into this owner-manager split. What does it actually look like, and why is it such a potential minefield for conflict?
Okay, this really lays it all out. On one side, you've got the owners, the shareholders. They're the ones who provide the cash, the capital, and all they really want is a good return on their investment. Makes sense, right? But then, on the other side, you have the managers. They bring the expertise and do the day-to-day work of running the company. Now, you'd think their goals would be perfectly aligned, but that's not always the case. A manager might be more focused on, say, getting a big year-end bonus or making a splash to build their own career, which might not be the best thing for the company's long-term success.
You know what's wild? This is not a new problem at all. The famous economist Adam Smith was writing about this exact issue all the way back in 1776. His point was simple, but it's so powerful. When people are managing money that isn't their own, they just aren't going to watch over it with the same level of care as if it were their own cash. And that, right there, that's the core of the entire governance challenge.
So this whole conflict actually has a name in the world of economics. It's called agency theory. The easiest way to think about it is like this. The shareholders are the principals. They're the owners. And they hire the managers to be their agents, to run the business on their behalf. The whole problem, the whole challenge, is making sure the agents are always acting in the best interest of the principals. And all the money and effort spent on making sure that happens, we call those agency costs. A huge goal of corporate governance is just to keep those agency costs way, way down.
Okay, so we've established there's this built-in conflict. The big question is, how do you manage it? How do you possibly build a system, a set of rules, that gets everyone on the same page and keeps the company pointed in the right direction? Well, let's get into the rules of the game.
The modern corporation, as we know it, is really built on 4 key ideas. First, you have limited liability. This is huge. It means if you invest in a company, you can only lose what you put in. Second, the company is its own legal entity, separate from its owners. Third, you can easily buy and sell your shares, which gives us the stock market. And fourth, you have centralized management, where shareholders hand over the day-to-day control to a board of directors. But, see that last one? Delegating control? That brings us right back to the agency problem we were just talking about. And that is exactly why having a strong governance system isn't just a nice-to-have, it's absolutely essential.
So what's the actual payoff for getting all of this right? I mean, what's the real, tangible value of good governance? Well, as you're about to see, the price people are willing to pay for trust is pretty high. Check this out. A huge survey by McKinsey found that investors around the world are willing to pay a premium, an extra price, of up to 30% for a company that has good corporate governance. 30%! That is a staggering number. It's a loud and clear signal from the market about just how much it values trust and accountability.
And that premium isn't just about trying to avoid the next big scandal. It's much more than that. It's about investors seeing a company that's a well-oiled machine. Things like having independent directors on the board, being totally transparent with the finances, communicating openly with shareholders. All of this stuff acts like a magnet for investment money. It means these companies can raise capital more easily, which helps them perform better, and in the end, that helps fuel the whole economy.
So all of this leads us to one of the biggest, most debated questions in the business world right now. For decades, the thinking was pretty simple. A company's only job is to make as much money as possible for its shareholders.
End of story. But now, that's changing. People are asking a much bigger question. What about a company's responsibility to its workers, its customers, to the environment, and to society as a whole? And how we answer that is really going to shape the future of corporate governance.